Are you tired of the emotional roller coaster that is the stock market? Do you dream of building lasting wealth and securing your financial future without succumbing to the latest fads or market panics? Then BookMind is exactly where you need to be. Today, we're diving into a book that Warren Buffett himself credits with shaping his entire investment philosophy, calling it by far the best book on investing ever written, Benjamin Graham's The Intelligent Investor. This isn't just a book, it's a foundational text, a timeless blueprint for navigating the unpredictable waters of Wall Street with logic, discipline, and a profound understanding of what truly matters. Get ready to transform your approach to money, because what you're about to learn will empower you to become a truly intelligent investor, regardless of market conditions. Let's unlock the wisdom of the ages together. Welcome to BookMind. Chapter 1. Investor versus Speculator, Defining Your Role. Approximately 500 words. Hello, BookMind family, and welcome to our deep dive into The Intelligent Investor. In this foundational chapter, Benjamin Graham immediately challenges us to define our identity in the financial markets. Are you an investor or are you a speculator? This distinction, he argues, isn't just semantics, it's the bedrock of your financial success and peace of mind. According to Graham, an investor is an individual who, through thorough analysis, seeks to protect their principal and obtain an adequate return. Their approach is characterized by discipline, research, and a long-term perspective. An investor views a common stock not as a ticker symbol to be traded, but as a fractional ownership in a real business. They are concerned with the company's financial health, its management, its competitive advantages, and its intrinsic value. For example, an investor will meticulously scrutinize a company's balance sheet, income statement, and cash flow, looking at years of earnings history and dividend payments, rather than buying simply because a stock is hot or has seen recent price momentum. The investor prioritizes a margin of safety, buying an asset for significantly less than its determined intrinsic value, providing a cushion against unexpected business setbacks or market downturns. Their goal is not to get rich quickly, but to get rich surely over time. In stark contrast, a speculator is primarily interested in anticipating and profiting from market fluctuations. They buy based on tips, short-term trends, headlines, or the hope that someone else will pay more for their asset later, a concept often referred to as the greater fool theory. Speculators often lack a deep understanding of the underlying business and focus almost entirely on price movements. For instance, a speculator might buy shares in a company based on a sensational news story or a sudden surge in price without ever looking at the company's fundamentals or long-term viability. Graham does not condemn speculation outright, but he makes it unequivocally clear that true wealth is built through intelligent investing, not through gambling on market sentiment. He issues a stern warning. Engaging in speculation without recognizing it as such is the most dangerous form of all, as it blinds individuals to the real risks they are taking. The core message of this chapter is profound. Self-awareness is paramount. Your financial decisions should stem from a clear understanding of your role. If you are committed to analytical rigor, patience, and focusing on the intrinsic value of businesses, you are on the path of an investor. If your primary focus is on quick gains, market timing, or reacting to every news cycle, you are operating as a speculator. Embracing the investor mindset provides a psychological fortress against the market's irrationality, allowing you to build sustainable wealth and achieve genuine financial security. This distinction is your first, most crucial step towards mastering your financial destiny. Are you ready to truly embrace the identity of an intelligent investor? If so, hit that like button. Share your thoughts on this fundamental distinction in the comments below and subscribe to BookMind to join us on this transformative journey. Chapter 2: Inflation and the Intelligent Investor. Welcome back, BookMind listeners. In this crucial second chapter, Benjamin Graham tackles a silent yet relentless destroyer of wealth. While many investors obsess over nominal returns, the simple percentage gain on their investments, Graham emphasizes that the intelligent investor must always consider the real return, which accounts for the erosion of purchasing power due to inflation. Inflation, simply put, is the rate at which the general level of prices for goods and services is rising, and consequently, the purchasing power of currency is falling. If your investment earns 5% in a year, but inflation is 3%, your real return is only 2%. Graham vividly illustrates how holding cash, or even certain types of fixed-income bonds, can lead to a significant loss of real wealth over time, even if their nominal value remains stable. A dollar today buys less than a dollar bought 20 years ago, and will buy even less 20 years from now. This insidious effect means that simply preserving your capital's numerical value is not enough. You must ensure its buying power is maintained and preferably grown. Graham doesn't offer a single magical solution to combat inflation, as its effects can vary and its future trajectory is always uncertain. However, he provides pragmatic guidance. Historically, common stocks, particularly those of financially sound and well-managed companies, have proven to be a good hedge against inflation over the very long term. This is because successful businesses can often raise the prices of their products and services to offset their own rising costs, thereby maintaining or even increasing their earnings power. However, he strongly cautions against blindly assuming this will always be the case, especially in periods of hyperinflation or economic turmoil. The key, he asserts, lies in selecting businesses with inherent strengths, competitive advantages, and the ability to adapt to changing economic environments. He also briefly touches on other potential inflation hedges, such as real estate or commodities, but always brings it back to the core principles of intelligent investing: thorough analysis, a margin of safety, and avoiding speculative fads. The intelligent investor's goal is not merely to achieve growth, but to preserve and grow their real wealth, protecting it from the hidden tax of rising prices. This requires a constant awareness of the economic environment and a portfolio strategy designed to withstand different inflationary scenarios. Ignoring inflation is akin to ignoring a slow leak in your financial boat. Eventually, you'll be underwater. By understanding its impact, you can make informed decisions that safeguard your financial future. Chapter 3: A Century of Stock Market History, a Rough Sketch. Hello, BookMind community. In this third chapter, Graham takes us on an essential journey through a century of stock market history, not to provide a detailed timeline of events, but to instill a crucial perspective for the intelligent investor. His rough sketch serves as a powerful reminder of the market's cyclical nature and its often irrational behavior, providing a bedrock for understanding market psychology. Graham observes that market history is characterized by alternating periods of excessive optimism and profound pessimism. He highlights the boom and bust cycles, from the speculative frenzy of the 1920s leading to the devastating crash of 1929, through various wars, recessions, and periods of robust growth. The core takeaway isn't to predict the next market move, a futile exercise for an intelligent investor, but to understand that market gyrations are a normal, inherent feature of investing. Prices can, and often do, diverge wildly from underlying intrinsic value in the short term, driven by emotion, herd mentality, and immediate news. He points out how frequently the market swings like a pendulum, from undervaluing assets to overvaluing them. During periods of euphoria, investors become overly confident, projecting ever-increasing earnings and paying exorbitant prices for stocks. Conversely, during downturns, panic sets in, leading to indiscriminate selling, driving prices far below their true worth. This historical perspective powerfully illustrates that "this time it's different" is almost always a dangerous fallacy. Human nature and market mechanics tend to repeat themselves, albeit with different actors and circumstances. The intelligent investor utilizes this historical context not as a crystal ball, but as a lens through which to view current market conditions with detachment and rationality. By understanding that past bubbles have burst and past panics have eventually subsided, investors can cultivate patience and discipline. When the market is overly optimistic, they resist the urge to chase rising prices. When it is overly pessimistic, they see opportunities where others see only despair. Market history teaches us that fortunes are often made during times of crisis by those who are prepared to buy sound businesses at depressed prices, and preserved by those who avoid the excesses of boom times. It reinforces the idea that an investor's true enemy is often their own emotions amplified by the crowd. By recognizing these patterns, you gain a vital psychological advantage, allowing you to remain calm and steadfast in the face of market volatility, confident in your long-term value-driven strategy.
Chapter 4. General Portfolio Policy. The Defensive Investor. Welcome back to BookMind. Chapter 4 introduces a cornerstone concept for what Benjamin Graham terms the defensive investor, an individual whose primary objectives are safety of principle and freedom from bother. This approach is not about being passive or disengaged. It's about being strategically disciplined, prioritizing stability and avoiding serious errors over aggressive high-risk pursuits. The defensive investor seeks respectable, reliable returns with minimal time and effort spent on daily analysis or market timing. Graham recommends a perpetually balanced portfolio for the defensive investor, typically divided between high-grade bonds and a diversified selection of common stocks. He suggests a range for this allocation, usually between 25% and 75% in either category, with a starting point often being a 50-50 split. The precise allocation within this range should be determined by the investor's personal circumstances, risk tolerance, and perceived market conditions. For instance, if the stock market appears significantly overvalued, a defensive investor might lean more heavily towards bonds, for example, 75% bonds, 25% stocks. Conversely, if stocks are deeply undervalued, they might shift towards a higher stock allocation, for example, 25% bonds, 75% stocks. The crucial element here is systematic rebalancing, not market timing. The defensive investor doesn't try to predict market tops or bottoms. Instead, they maintain their desired allocation by periodically adjusting their portfolio. If their stocks perform exceptionally well and now constitute 60% of their portfolio, exceeding their 50% target, they would sell enough stocks to bring the allocation back to 50% and use the proceeds to buy more bonds. If bonds perform better or stocks decline, leading to a 40% stock allocation, they would buy more stocks to return to 50%. This strategy has several powerful benefits. It automatically forces the investor to buy low and sell high, removes emotion from investment decisions, and ensures a continuous focus on maintaining a balanced risk profile. For the common stock portion, the defensive investor focuses on quality. Graham advises investing in large, prominent, financially strong companies with a long history of continuous dividend payments and stable earnings. Diversification is key. Rather than concentrating on a few stocks, the defensive investor should hold a sufficient number, for example 10 to 30 of such companies, to minimize the impact of any single stock's poor performance. This portfolio policy is designed for peace of mind, reliable long-term capital appreciation, and consistent income, making it ideal for investors who value security and a clear, manageable approach to wealth building.
Chapter 5. General Portfolio Policy. The Enterprising Investor. Hello, BookMind listeners. While Chapter 4 focused on the conservative and consistent approach of the defensive investor, Chapter 5 shifts gears to introduce the enterprising investor. This individual is willing to dedicate significant time, effort, and intellectual curiosity to active portfolio management, seeking returns superior to what the defensive investor might achieve. However, Graham is quick to clarify, this is not about reckless speculation. It is about actively seeking out undervalued opportunities through diligent research and a commitment to value principles, always maintaining a margin of safety. The enterprising investor understands that superior returns often require more than just buying an index fund or a diversified basket of large-cap stocks. They believe that opportunities exist in the market that are overlooked or mispriced by the broader investment community. Graham outlines several areas where an enterprising investor might find an edge, but he stresses that success in these areas demands rigor, patience, and a willingness to go against conventional wisdom. One common area is investing in less popular, larger companies that have temporarily fallen out of favor with the market. These might be well-established businesses experiencing a temporary setback, or those in industries that are currently out of vogue. The market often overreacts to bad news, driving good companies to unfairly low prices, creating opportunities for the discerning investor. Another avenue is carefully selected growth stocks. While the defensive investor might avoid these due to their higher perceived risk and often elevated valuations, the enterprising investor might identify a growth company whose future potential is significantly underestimated by the market, ensuring that even with growth, there's still a margin of safety. Graham also touches on special situations, such as spin-offs, liquidations, or reorganizations, where complex corporate events can unlock hidden value. However, he warns that these require advanced analytical skills and a deep understanding of legal and financial nuances. What ties all these strategies together is the requirement for deep fundamental analysis. The enterprising investor is not relying on market momentum or expert opinions. They are scrutinizing financial statements, understanding business models, assessing management quality, and evaluating competitive landscapes. They are seeking quantifiable discrepancies between a company's market price and its intrinsic value. This approach demands intellectual honesty, a strong stomach for going against the crowd, and an unwavering commitment to research. While the potential for higher returns exists, so does the need for greater effort and skill. The enterprising investor is, in essence, an analytical detective, constantly searching for value where others see only risk, complexity, or disinterest. They are disciplined in their search for bargains, understanding that true investment success comes from sound analysis, not market timing. Chapter 6. Stock Selection for the Defensive Investor. Welcome back to BookMind. Building on the principles of the defensive investor discussed in Chapter 4, Benjamin Graham dedicates Chapter 6 to providing concrete, practical guidelines for stock selection for the defensive investor. This isn't about finding the next big thing or chasing high-flying stocks. It's about systematically building a portfolio of sound, reliable businesses that offer stability, income, and long-term capital appreciation with minimal risk and effort. Graham provides a specific set of criteria, almost a checklist, designed to ensure quality and a perpetual margin of safety. Here are Graham's key criteria for defensive stock selection. Adequate size of the enterprise. Graham suggests that defensive investors should only consider large, prominent, and established companies. Larger companies tend to have more stable earnings, greater financial resources, and a proven ability to weather economic downturns. This criterion helps filter out smaller, more volatile businesses that might be suitable for an enterprising investor but pose higher risks for a defensive one. Sufficiently strong financial condition. This is measured by two main factors. First, a current ratio of at least 2 to 1. The current ratio is current assets divided by current liabilities. A ratio of 2 or higher indicates that a company has ample liquid assets to cover its short-term obligations. Second, debt not exceeding common stock equity. This means that the company's total debt should be less than its total equity, shareholder stake, signifying a conservative and financially sound capital structure. Earnings stability. The company must have a long record of continuous earnings for at least the past 10 years. This demonstrates resilience and predictability in its business model, indicating it can generate profits consistently through various economic cycles. History of continuous dividend payments. The company should have paid dividends continuously for at least the past 20 years. A long history of consistent dividends is a strong indicator of financial health, management's commitment to shareholders, and the generation of real, distributable earnings. Earnings growth. While defensive investing isn't about aggressive growth, Graham does look for some evidence of modest growth. He suggests a minimum increase of at least 1/3 in earnings per share over the past 10 years, using a 3-year average at the beginning and end of the period to smooth out short-term fluctuations. Moderate price-to-earnings ratio. The current price should not be more than 15 times the average earnings of the past 3 years. This ensures the investor is not overpaying for the company's earnings power, providing a margin of safety on the valuation front. Moderate price-to-book ratio. The current price should not be more than 1.5 times the tangible book value per share. The book value represents the company's net assets. A low P/B ratio indicates that the investor is buying assets at a reasonable price relative to their accounting value. Graham also adds a combined rule. The product of the P/E ratio and the P/B ratio should not exceed 22.5. For example, if P/E is 10, P/B should be no more than 2.25. These strict criteria, while seemingly conservative, are designed to filter out speculative ventures and focus on established, well-managed businesses trading at a fair rather than inflated price. This disciplined approach minimizes risk, provides a solid foundation for long-term wealth accumulation, and offers peace of mind for the defensive investor who prioritizes safety and consistency.
Chapter 7. Stock Selection for the Enterprising Investor. Negative Approach and Positive Approach. Hello, BookMind community. Chapter 7 builds upon the concept of the enterprising investor, diving into specific, active strategies for finding undervalued stocks. Benjamin Graham outlines 2 primary yet interconnected approaches for this diligent investor: the negative approach and the positive approach, both fundamentally rooted in the unwavering search for a margin of safety. The negative approach is about proactive risk management and avoidance.
Before seeking out opportunities, the enterprising investor first filters out certain types of stocks that carry inherent risks or are unlikely to offer a sufficient margin of safety for their active efforts. This includes avoiding speculative growth stocks. Companies whose valuations are based almost entirely on highly optimistic future earnings projections, with little to no current profitability or tangible assets to back them up. Graham warns that such stocks often carry significant downside risk if those projections fail to materialize. Shying away from weak financial conditions. Companies with high debt, poor cash flow, or a precarious balance sheet are generally excluded. While an enterprising investor might be willing to take on some risk, fundamental financial weakness is often a red flag that even deep analysis cannot overcome. Exercising caution with highly cyclical or faddish industries. Businesses subject to extreme boom and bust cycles or fleeting trends are often difficult to value reliably and can lead to significant capital impairment. The essence of the negative approach is to first eliminate obvious pitfalls and areas where the investor's edge is unlikely to be found. It's about preserving capital by sidestepping common, enticing mistakes, recognizing that avoiding bad investments is as crucial as finding good ones. Once the no-go areas are defined, the positive approach comes into play, focusing on actively seeking out specific types of value opportunities. Graham highlights a few key strategies. Bargain issues, net stocks. This is one of Graham's most famous and conservative strategies. It involves identifying companies whose market price is less than their net current assets minus total liabilities. In essence, you are buying the company's liquid assets, cash, accounts receivable, inventory, for less than their market value, getting the fixed assets, property, plant, equipment, and the ongoing business for free. These are often distressed companies that the market has completely given up on, but they offer an enormous margin of safety. While less common today due to increased market efficiency, the principle of buying below liquidation value remains powerful. Unpopular large companies. Investing in well-established, fundamentally sound companies that have fallen out of favor with the market due to temporary problems, bad news, or simply being in an unexciting industry. The market often overreacts to short-term setbacks, driving prices below intrinsic value, creating opportunities for the patient, discerning investor. Carefully selected growth stocks with a margin of safety. Unlike the speculative growth investor, the enterprising investor might consider growth stocks if they can acquire them at a price that still provides a substantial margin of safety. This means finding growth companies where the market has underestimated their long-term earning power and stability, allowing for upside even if growth projections are slightly off. This requires meticulous valuation and a sober assessment of future prospects. The enterprising investor applies rigorous fundamental analysis, looking for quantifiable discrepancies between price and value. This demands patience, a strong analytical mind, and the courage to invest against prevailing sentiment. It's about exploiting market inefficiencies by thoroughly understanding the true worth of a business and buying when that value is significantly discounted. Chapter 8: The Investor and Market Fluctuations. Welcome back to Bookmind. Chapter 8 is arguably one of the most pivoted chapters in The Intelligent Investor, as Benjamin Graham directly addresses the emotional and often irrational nature of market fluctuations and introduces his legendary allegory of Mr. Market.
This concept provides the ultimate psychological framework for maintaining discipline and making rational decisions in a volatile financial world. Graham personifies the stock market as a manic-depressive business partner, whom he calls Mr. Market. Every single day, Mr. Market knocks on your door and offers to buy your shares or sell you his shares. On some days, Mr. Market is utterly euphoric. He sees nothing but sunshine and rainbows, believes the future is limitless, and offers to buy your shares at incredibly high, often ridiculously optimistic prices, or sell you his shares at prices far above their true intrinsic value. On other days, Mr. Market is deeply despondent and terrified. He sees only gloom and doom, believes the world is ending, and offers to sell you shares at rock-bottom prices or buy your shares for next to nothing. The profound insight Graham offers is this: the intelligent investor understands that Mr. Market's daily pronunciations are merely invitations, not directives. You are under no obligation to accept his offers. You don't have to sell just because he's depressed, and you don't have to buy just because he's ecstatic. Instead, the wise investor uses Mr. Market's irrationality to their advantage. When Mr. Market is exuberant and offering sky-high prices for your holdings, that might be an opportune time to sell some shares, especially if they are significantly overvalued relative to your assessment of intrinsic worth. Conversely, when Mr. Market is depressed, fearful, and offering to sell shares at deeply discounted prices, that is precisely when the intelligent investor, armed with thorough analysis, sees opportunities to buy sound businesses at attractive valuations. The key is to detach emotionally from the market's daily swings and deafening noise. Your focus should remain steadfastly on the underlying value of the businesses you own or wish to own. Do not let Mr. Market's capricious mood dictate your actions. Your independent analysis of intrinsic value should be your unwavering guide. By treating Mr. Market as a servant to be utilized rather than a master to be obeyed, you empower yourself to profit from the market's folly rather than falling victim to it. This mental framework is crucial for resisting the twin enemies of greed and fear, which often compel investors to buy high and sell low. It instills the patience and conviction necessary to be a successful long-term investor, turning market volatility from a threat into an opportunity.
Chapter 9. Investing in Investment Funds. Hello, BookMind listeners. In Chapter 9, Benjamin Graham delves into the world of investment funds, specifically mutual funds, providing invaluable guidance for the intelligent investor considering this avenue. He acknowledges a fundamental truth. Not everyone has the time, inclination, expertise, or even the desire to manage their own portfolio of individual stocks and bonds. For these individuals, investment funds, when chosen wisely, can be a viable and intelligent solution for achieving diversification and professional management. However, Graham is far from offering a blanket endorsement of all funds. He emphasizes the critical importance of understanding several key factors before entrusting your capital to a fund. Fees and expenses. This is perhaps Graham's strongest point of caution. He stresses that high expense ratios, management fees, sales charges, loads, and other hidden costs can significantly erode long-term returns, often far more than investors realize. He strongly prefers funds with low expense ratios, advocating for cost efficiency as a primary selection criterion. A fund's performance, even if seemingly good, can be negated by excessive fees over decades. Investment philosophy and strategy. The intelligent investor must thoroughly understand the fund's stated investment objectives and strategy. Does it align with their own risk tolerance and long-term goals? Graham cautions against funds that engage in excessive trading, which incurs higher transaction costs and can trigger capital gains taxes, or speculative strategies, as these often lead to underperformance relative to simpler, more disciplined approaches. Diversification. A well-managed fund should provide broad diversification, reducing the risk associated with individual stock selection. This is one of the primary benefits of funds for the defensive investor. For the defensive investor, Graham often suggests considering diversified index funds. These funds passively track a broad market index like the S&P 500 and inherently embody many of Graham's principles: broad diversification, low turnover, and typically very low expense ratios. They do not attempt to beat the market, but rather to match the market's return, which, for many, is a perfectly acceptable and often superior outcome compared to actively managed funds after fees. He also suggests looking for actively managed funds that genuinely adhere to a value-oriented investment strategy, similar to his own principles. These funds would focus on buying undervalued companies with a margin of safety, rather than chasing growth or momentum. Even then, Graham advises looking for funds with a consistent, long-term track record of outperforming their benchmarks after fees, but he always reminds investors that past performance is not a guarantee of future results. Ultimately, the intelligent investor evaluates funds with the same critical eye they would apply to individual stocks. They do not blindly follow ratings or marketing hype. They ensure the fund's structure, costs, and investment philosophy align with their long-term goals, risk tolerance, and commitment to value investing. It's about finding professional management that acts in your best interest and provides broad diversification at a reasonable cost, rather than overpaying for illusory promises of market-beating performance.
Chapter 10: The Intelligent Investor and Financial Advisors. Welcome back to BookMind for our final summary chapter. In this concluding segment, Benjamin Graham provides invaluable practical advice on navigating the often complex world of financial advisors. He acknowledges that for many investors, especially those who are busy, lack the time or inclination for deep analytical work, or simply need expert guidance, a financial advisor can be a beneficial and even essential partner in their financial journey. However, he stresses the critical importance of choosing the right advisor, one who genuinely serves your best interests. Graham issues strong warnings against common pitfalls when selecting an advisor. Advisors promoting speculative strategies. Be wary of advisors who promise unrealistic returns, advocate for constant trading, or push investments that lack a clear margin of safety. An intelligent investor will focus on long-term wealth building, not short-term speculation. Churning portfolios. Avoid advisors who seem to be constantly buying and selling investments in your portfolio, as this often generates commissions for them if they are commission-based, but incurs unnecessary transaction costs and potential tax liabilities for you. Conflicts of interest. This is a major concern for Graham. An advisor might recommend certain products or funds because they receive higher commissions or incentives from those providers, rather than because they are truly the best option for you. The intelligent investor should seek an advisor who operates under a fiduciary standard. This is a crucial distinction. A fiduciary advisor is legally and ethically bound to act solely in your best financial interest, putting your needs above their own. This is in contrast to a suitability standard, where an advisor only needs to recommend products that are suitable for you, which leaves more room for products that might benefit the advisor more. Look for advisors who emphasize and practice the core tenets of intelligent investing. Long-term, value-oriented investing,
An advisor aligned with Graham's philosophy will focus on buying quality assets at fair or undervalued prices with a long-term horizon, rather than chasing market fads. Diversification. They will advocate for a well-diversified portfolio across different asset classes, stocks, bonds, cash, to mitigate risk. Disciplined approach. They will help you create and stick to an investment plan, guiding you through market volatility rather than reacting emotionally. Transparency. A good advisor will be clear about all fees, their compensation structure, and the rationale behind their recommendations. Fee-only advisors who are compensated directly by their clients, example a percentage of assets under management or an hourly fee, often have fewer conflicts of interest than those paid through commissions. Ultimately, even with a trusted advisor, the intelligent investor never fully abdicates their responsibility. You should remain engaged, understand your financial plan, and be prepared to ask informed questions. The advisor is a guide, a counselor, and an executor of strategy, but you remain the ultimate decision maker and the driver of your financial destiny. This chapter empowers you to build a trusted, transparent relationship with a financial advisor who truly aligns with your intelligent investing principles, helping you navigate complex financial decisions with confidence and clarity.
And there you have it, a comprehensive, detailed journey through Benjamin Graham's The Intelligent Investor. We've traversed the essential distinctions between investor and speculator, battled the insidious effects of inflation, gleaned wisdom from a century of market history, developed robust portfolio policies for both defensive and enterprising investors, navigated the intricate process of stock selection, mastered the psychological challenge of Mr. Market, and wisely approached the worlds of investment funds and financial advisors. The wisdom contained in this book is truly transformative. It teaches us that successful investing isn't about brilliance, insider information, or constant market watching. It's about discipline, patience, independent thought, and a fundamental, unwavering understanding of intrinsic value. It's about making rational decisions in an often irrational world, building wealth steadily and securely, and achieving genuine financial independence. This book is a beacon of common sense in a sea of financial noise. If you've absorbed these profound insights and feel more empowered and confident as an investor, please do us a huge favor. Hit that like button. Leave a comment below sharing your biggest takeaway or aha moment from this entire summary series, and subscribe to BookMind for more invaluable knowledge that will help you master your money and expand your mind. Thank you for joining us on this essential journey. Until next time, keep investing intelligently and keep expanding your book mind.